Donald Trump's sweeping tariff policies and trade restrictions, once hailed as a strong-arm strategy to protect American industry, have now triggered consequences no one saw fully coming. Stellantis, one of the largest automakers in the world, has begun shutting down or scaling back several U.S. manufacturing plants, a decision that until recently would have seemed unthinkable. With this move, Stellantis isn't just reacting to market forces. It is sounding a dire warning. Protectionist policies have limits, and those limits may have been crossed. The story begins when the Trump administration doubled down on its import tariffs, especially targeting steel, aluminum, and critical vehicle components. The America First doctrine, meant to safeguard domestic manufacturers, raised input costs sharply. Suppliers and automakers across the board struggled to find affordable raw materials. Stellantis, which depends heavily on tiered supply chains for components both from abroad and domestically, suddenly faced rising pressures. Tariffs that once seemed like leverage became burdens. By mid-2024, suppliers notifying Stellantis that costs for raw materials and component parts had shot up 30 to 50% compared to just a year earlier. Aluminum tariffs alone caused a ripple. Body panels, chassis parts, even interior trim suddenly cost far more. Meanwhile, retaliatory tariffs from trading partners added insult to injury. Nations hit by U.S. tariffs struck back, levying duties on U.S. exports, including automotive parts and finished vehicles. This hampered Stellantis' ability to export from U.S. plants and forced reconsideration of where to build cars for global markets. What made matters worse was dwindling consumer demand. Elevated prices passed to buyers, both for cars and for the cost of living, as energy, raw goods, and transportation all rose. Inflation pushed consumers away from new car lots, especially the kinds of mid-size sedans and crossovers that Stellantis specialized in. Sales in the Rust Belt states dropped sharply. Observers noted that where profits had been margin-thin, losses were now becoming real. Stellantis' U.S. factories, many designed for volume, were operating well below capacity. Shrinking volume made fixed costs, factory maintenance, labor, regulatory compliance, a heavier burden. Internally, Stellantis executives faced a dilemma: continue operations in U.S. factories that were losing money, or pivot production overseas where input costs, imports, labor rules, and trade retaliations were more predictable. The tipping point came in late 2024 when Stellantis announced it would close 2 plants and cut staffing at 3 more. One plant, long a staple in Michigan, ceased production of popular SUVs. Others were retooled but left the U.S. supplier base behind. The message to investors: operating in the current policy environment is unsustainable. Yet this isn't just a Stellantis story. It illuminates a broader truth. When government policy disrupts supply chains, it distorts not only cost structures, but strategic planning. Companies built global networks explicitly to hedge against risk. Trump's escalating tariffs upset those calculations. Stellantis, Ford, GM, and others are now rethinking where to locate factories, how many to build, and what part of the value chain to own in-house versus import. And this ripple is beginning to reach beyond auto. Suppliers of semiconductors, plastics, chemicals tied to vehicle manufacturing are also revising forecasts. Trade economists warn the auto industry is one of the most sensitive barometers for policy shock because of its complex international dependencies. When tariffs rise, so do costs. When export barriers multiply, so do losses. When consumption falls, capacity utilization drops. The convergence of these forces has turned what once seemed like protective policies into a funnel squeezing manufacturers from all sides. Stellantis' decision to leave or scale back U.S. plants may be just the opening act of a broader retreat from American industrial capacity. What happens next is critical. Will policymakers take note of the damage? Will there be compensation, rollback, or renegotiation? Or will Stellantis and others continue to reinvest abroad, leaving U.S. regions hollowed out? Because if the trend continues, it's not just factories at stake, it's jobs, local economies, and the question of whether the U.S. can still boast a viable auto manufacturing sector by the end of this decade. Stellantis' retreat from the U.S. market was not an overnight decision. It was the culmination of pressures building over months, even years. After the first plant closures, shockwaves rippled across the auto sector. Industry analysts began issuing warnings that this was not an isolated event, but the first sign of a structural shift. For decades, automakers operated in a world of predictable trade policies. Even when occasional disputes erupted, they were usually resolved before causing lasting harm. But the current environment under Trump's escalating tariffs shattered that sense of stability. Companies now face a world where trade routes, supply chains, and consumer markets can change overnight with the stroke of a pen in Washington or Beijing. Inside Stellantis' corporate boardrooms, debates grew intense. Executives examined profit and loss statements that painted a bleak picture. U.S. plants bleeding money while factories in Mexico, Canada, and even parts of Europe remained relatively stable. Labor costs in America were rising. Regulatory uncertainty was constant, and raw material prices refused to return to pre-tariff levels. Moving production abroad offered immediate savings. Mexico, for instance, provided proximity to the U.S. market, but without many of the punitive tariffs or expensive labor requirements. Southeast Asia and Eastern Europe offered even cheaper labor and access to emerging markets. From a purely financial standpoint, the decision to leave American soil was difficult, but rational. The human cost, however, is harder to quantify. Communities built around Stellantis plants suddenly faced the prospect of mass layoffs. Local suppliers dependent on factory contracts watched as orders dried up. Restaurants, shops, and small businesses that served plant workers braced for declining customers and shrinking incomes. Economists call this the multiplier effect. Every factory job supports several additional jobs in the local economy. When Stellantis cuts one worker, the real impact spreads far wider. Mayors and governors pleaded for federal intervention, but Washington appeared reluctant to admit that its own policies had contributed to the crisis. Meanwhile, competitors watched closely. Ford and GM executives hinted privately that they too were exploring options outside the U.S. if tariff pressures persisted. Foreign automakers with U.S. operations like Toyota and Volkswagen warned that rising costs threatened their American manufacturing footprints. The fear was clear: Stellantis might be the first domino, but it would not be the last. Global investors reacted swiftly. Stellantis stock initially fell on news of the closures, but then recovered as analysts predicted higher profits from shifting production overseas. Wall Street seemed to reward offshoring even as U.S. workers paid the price. Critics accused the Trump administration of undermining its own promise to revive American manufacturing. Instead of bringing jobs back, tariffs appeared to be driving them away. The symbolism was hard to ignore. Factories once celebrated as proof of America's industrial strength now stood silent, reminders of policies gone wrong. By early 2025, the debate over Stellantis and the broader U.S. auto industry had transformed from an economic issue into a full-blown political crisis. Congressional hearings demanded explanations from both company executives and administration officials. Supporters of the tariffs argued that short-term pain was necessary to protect long-term sovereignty over strategic industries. They claimed that relying on foreign supply chains, particularly for critical materials like semiconductors and rare earth metals, was a national security risk. But critics countered that the policy had backfired spectacularly. Instead of strengthening domestic industry, it had accelerated the very offshoring it was supposed to prevent. For Stellantis, the calculus was brutally simple. The global auto industry is shifting toward electric vehicles, autonomous driving, and advanced software integration. Competing in that space requires massive investments in R&D, battery technology, and semiconductor partnerships. Every dollar wasted on higher raw material costs or tariff penalties is a dollar diverted from innovation. By moving operations abroad, Stellantis not only cut costs, but also positioned itself closer to emerging EV supply chains in Asia and Europe. China, for example, dominates the global battery market, while Europe leads in emissions regulations and EV infrastructure. From a strategic standpoint, Stellantis saw little reason to anchor itself in a U.S. market tangled in political and economic uncertainty. The social consequences deepened as layoffs spread across Michigan, Ohio, and Illinois. Thousands of workers suddenly found themselves without steady paychecks in towns where auto plants had been the backbone for generations. Union leaders staged protests, demanding government relief and accusing politicians of sacrificing workers for political theater. Editorials in major newspapers carried headlines like "Tariffs and Tumult: How Policy Dismantled a Legacy," capturing the growing sense of betrayal in communities once promised a manufacturing renaissance. Internationally, trade partners responded with both concern and opportunity. Mexico offered Stellantis tax incentives to expand operations south of the border. European governments courted the company with subsidies for EV research centers. Asian nations, eager to capture the next wave of automotive innovation, invited investment with promises of cheap labor and advanced technology hubs. The global race for Stellantis' future accelerated, while American policymakers debated whether to double down on tariffs or seek compromises to lure manufacturing back. In financial markets, analysts warned that the Stellantis episode could mark the beginning of a broader exodus. If one major automaker found U.S. operations untenable, others might follow, creating a slow bleed of industrial capacity. That, in turn, would erode the tax base, strain social services, and weaken the very communities tariffs were supposed to protect. As 2025 unfolded, one question loomed over Washington, Wall Street, and Main Street alike. Had America, in trying to shield its industries, instead driven them away?